You are all welcome to One Touch Professional School. I pray we are all doing well. We continue our discussions on financial accounting paper 1.1. We're looking at the concept of bad debts, doubtful debts, bad debt recovered, and allowance for doubtful debts, generally referred to as end of year adjustments. Now, in this session, we're going to look at certain adjustments that are done before a company prepares its end of year financial statements. And bad debt, doubtful debt, bad debt recovered, and allowance for doubtful debt are some of the adjustments. Later in this section, we'll be looking at accruals and prepayments as well. Okay, so in this session, our first concentration is going to be on how to account for bad debts, doubtful debts, bad debts recovered, and allowance for doubtful debt, otherwise known as provision for bad and doubtful debts. Great. Now, you know that generally businesses carry out their business on credits. And so there is a possibility that once a business sells on credits, okay, some businesses may fall into financial difficulties and therefore may not be able to honor their debt as and when it falls due. Great. Now, as a result of that, now when a particular debt proves uncollectible or irrecoverable, now there is the need for the business to act prudently, not to keep that debt in its books. Okay, and therefore it requires that certain write-offs be done. Okay, good. Now there will also be instances where there are certain debts where there is an objective evidence that the debtors concerned may not be able to pay, or there is a doubt as to their ability to pay. Now, when that happens, there is also the need for us to recognize, okay, a portion of those debts also as doubtful. Okay, now how do we account for those things as well? That is generally what we are going to look at under this section. Good. So let's look at a brief intro to this session. Then we'll look at the nitty-gritties. Great. Now, if sales are made on credits, there is always a chance that some customers will fall into financial difficulty and be unable to pay what they owe. It will be misleading to the users of financial statements if a business continue to show receivables where there is no chance or only a slight chance of collecting them. Now, the application of the concept of prudence would require that there should be an adjustment to reflect the fact that there are some receivables which the business thinks that it will not recover. Now, there are two categories of problem receivables for which adjustment may be required. Okay, there are two categories of problem receivables for which adjustment may be required. So let's look at the very first one. We talk about bad debts, or what is otherwise known as irrecoverable debts or irrecoverable receivables. Good. Now, a bad debt is an amount owed by a customer that the business believes it will never be able to collect. Okay, a bad debt is an amount owed by a customer that the business believes it will never be able to collect. Examples of situations that might lead to the conclusion that a receivable is irrecoverable include one, the bankruptcy or insolvency of a customer. The bankruptcy or insolvency of a customer. Okay, the death of a customer who has left insufficient asset to pay off his debts. 3, a dispute with the customer over whether a contract has been fulfilled or not. And 4, the dishonesty of a customer. That is where a person has obtained goods on credit with no intention to pay. What are we discussing here? Now, we know that businesses carry out their business on on credit. Okay. Now, once a credit has been advanced to customers, now we are saying that there is the chance or there's a probability that some of the customers may not be able to pay genuinely. Others may fall into some serious financial issues, and therefore they may not have the money to come and pay. Okay, and so we have to look at some of the instances where a debt may be uncollectible, okay, or a particular debt may prove uncollectible by the business, okay. And so we look at a situation where a customer has been declared bankrupt or insolvent, okay, where a customer dies and there is no enough funds left behind to be able to pay off the debts owed by that customer. Again, where there is a dispute between the business and its customers, whether a particular contract has been fulfilled, or where a customer is dishonest, that is, he came or that person came to buy goods with the intention that he will never pay. Okay, good. Now, when such a thing happens, do we still keep those debtors in our books, knowing very well that we will never receive those funds? Good. So what we are saying here is that when a debt proves uncollectible by the entity, and there's an objective evidence that the person is bankrupt or is insolvent, that the person is dead and there is no funds available, okay, to pay off the person's debts, now that debt needs to be considered as what? As a bad debt. And it all arises because of the fact that we sell goods, or a business sells goods or not on credits. And once goods are sold on credits, now you give the customer some time to come and pay. If after waiting, and the person does not come to pay, you can't still keep that receivables in your books. Okay, so therefore, at a point, there is the need for the business to reckon that these debts are not collectible, and therefore we need to consider them as as bad debts. Good. This is a situation that we're looking at. Then there are situations where a particular debt is doubtful. So we have doubtful debts. Now, a doubtful debt is an amount owed by a customer that the business believes might prove difficult to collect, but still hope to do so. For example, the business might know that the customer is in difficulty, but that he might be able to work his way out of it. This casts doubt on the collectibility of the receivables, but it still might be possible if the customer is able to recover from his difficulties. Okay. Now let's look at situations which may lead to the conclusion that a receivable is doubtful. What are the indicators? What will show that a customer is in some financial difficulty, and therefore there is a doubt as to their ability to pay their debts? Now, one, when a customer is experiencing serious cash flow problems. Okay, now a customer taking an unusual long time to settle a debt, that is not the customer's nature. As and when he buys, when the terms of the credit is due, the person comes and pay. But all of a sudden, the person is not able to honor his obligations, and therefore, if waited for some time, maybe 3 months has elapsed, 6 months has elapsed, 9 months, and the person has not been able to pay. Now, that will give you an indication that no, this is not how this customer deals with us. And therefore, if there has been some form of delay in payment, then it's an indication that we getting that amount is in doubt. Again, a customer experiencing operational difficulties which might lead to financial problems. For example, where there are strikes, natural disaster, disrupting production, among other things. Okay, good. These are things that may give you an indication that a particular debt is doubtful. Now, here we are not saying that it is proven to be to be bad. No, we are saying that the customer maybe may find itself in some form of financial condition which does not permit the person to make or honor its debt. Okay, as and when it falls due. However, we still hope that the customer will come out of that situation and be able to pay. So that is different from bad debt. In the case of a bad debt, the debt has proven to be uncollectible. Okay, and therefore there is a need for the business to write off that debt. In the case of doubtful, we are saying that the amount is in doubt. We are having some form of doubt that the customer may be able to pay. Okay, good, good. So that is the distinction between a bad debt and a doubtful debt. Good. Now, the prudence concept, okay, says that a business should not show an asset in its financial statement at an amount greater than the cash it will what? Generate. When such a circumstance arises, the asset is reduced in value down to the cash expected to result from the ownership of the what? Of the asset. Good. So what should we do? How do we write the value of the asset down when we expect that the amount stated in the financial statement may be greater than the cash that asset will be able to generate? Okay, good. So that leads us to what is called accounting for bad, doubtful debt, and what allowance for doubtful debt. If a debt, okay, proves doubtful, now there is the need for us to what? Make an allowance. There's the need for us to make an allowance for that debt. Allowance in the sense that since we have we have come to a conclusion that the collectibility of that debt is in doubt, we shouldn't wait for the debt to actually go bad. We should make an allowance. We should provide for that debt. Okay, we should tinker around that debt to say, okay, maybe this percentage of this debtors will not come and pay. Okay, because of ABC condition. So the allowance should also be premised on indications and factors that have been proven to be true. That okay, oh, last year this percentage of our customers didn't come and pay, or this percentage of receivables were not received, and upon investigation we realized that there were customers who were in some form of difficulty. Okay, so having established that, now you can use that one as a basis, okay, for subsequent periods to be able to build on those provision or those allowances. Okay, good. And so that is the concept of bad debts, doubtful debts. Okay, so now how do we account for bad, doubtful, and allowance for doubtful debts? Good. Now we are saying that when a specific debt or receivable is considered bad or irrecoverable, it is written off. Now, when a debt is written off, don't forget that. 1 minute. Now, we shouldn't forget that when a credit sales is made, right? Now, what entries are passed? We debit what? Now, when a credit sales is made, okay, why is there a bad debt? Why is there an irrecoverable debt? Or why is there a doubtful debt? Now, there's a doubtful debt because the business made some sales on credit, and these people are not paying. So on credit sales, we know that we debit, right, trade receivables, accounts. And what do? We credit our sales account. Okay, good. That is what we do when sales is made. We debit our trade receivables account and we credit our sales account. Now, a particular debt has now proven uncollectible. So what do? A particular debt has proven uncollectible. So what do? Now I said that when a debt proves uncollectible and therefore it is written off, what we should do is that now the debtor's figure, okay, on sale, we debit trade receivable. It's an asset. As we debit it, it increases. Then we credit our sales account. Sales is an income account. When an income account is credited, it also increases. Now, this sales made, we are saying that now the people are not paying. So what do? Now, that amount needs to be written off. How do we write it off? Now, it means that the debtors figure should be reduced. So for an asset debtors to reduce, you need to credit it. Okay, now by we reducing the debt, we shouldn't forget that debt resulted in an income, and the income is in the what? Profit or loss, or it is in an income statement. So now that we are writing off that debt off, it means that the income that we recognized in the financial statement in the year in which the sale was made must be what? Must be reversed. So that amount of uncollectible that must be recognized as what? As an expense now, so that it reduces the income for the current period. So when a debt proves uncollectible, we are saying that we debit our what? Bad and doubtful what? Debt what? Expense accounts. Okay, we need to debit it because it's an expense. It's an income which has proven uncollectible. So now it has become an expense to us. Then we should now reduce the what? The trade itself. So we credit what? Trade receivables what? Accounts. So this is the double entry when a particular debt is what? Uncollectible. So that is bad debt written what? Off. Okay. When a debt is written off, we debit bad and doubtful debt expense accounts and we credit trade receivables what? Accounts. Great. Now, what if a debt that has previously been what? Written off is now what? Recovered. What do we do? Good. So what you are saying here is that when a particular debt that has been written off is recovered, okay, now what we wrote off has now been received. Now, when the debtor come and pay, he will pay in cash or in check. So we are saying that on receipt of the money, now debit your bank or cash account. Okay. Now, and now do what? Credit the bad and doubtful debt expense what? Account. Okay. Good. Because when it was written off, we debited bad and doubtful debt, meaning bad and doubtful debt will increase. So now that the money has been received, it means that we must reverse, okay, the expenses that we recognize by what? Crediting the bad and doubtful debt account. And because you are receiving money, we now debit our bank or cash what? Account. Good. Good. Now, what if an allowance for doubtful debt is made? Don't forget that we said that doubtful debt is a debt where there is doubt as to its collectability. It's not a debt that is not recoverable. We just have doubt as to whether we will receive it or not. So when we are in doubt, what should we do? Now, the accounting treatment of doubtful debt has to serve two objectives. One, the exercise of prudence requires that the value of the receivable should be adjusted downwards, perhaps to zero, and an expense recognized for the loss in value. But the receivables must stay in the accounting records so that the business continues to chase payment. In the case of doubtful debt, we are saying that the debt is just in doubt. We are just wondering whether we will receive it or not. And so, since we are in doubt, we are saying that we shouldn't wait for the amount to really go bad, but we should rather start making an allowance. We should rather start providing. Should in case this debt goes bad, then we are not hit. So prudence says that we should rather anticipate for losses rather than gains. Okay, because if you anticipate for gains and the gains do not come, you may deceive, or you might have deceived financial statement users. However, if you anticipate for losses and they turn out to be gains, that is better. Do you get the point? Great. So by exercise of prudence, you are saying that we should those debts that are in doubt, we should start providing for them. We should recognize a portion of those debts as as an allowance, as something that we may not get. Okay, good, and provide for them. Okay, good. So what we are saying here is that this is achieved in the following way. Instead of writing off the debt, which would remove it from the records, a business sets up an allowance account shown below. So when a debt is in doubt, we are saying that we should create an allowance account. We should create an allowance account to provide, to write off those debts that are in doubt gradually. We shouldn't wait for the major hits. We shouldn't wait for the debt to prove uncollectible before we write it off. We should rather make a provision. We should rather make an allowance for that debt. Okay, good. And so what do we do? Now, when a doubtful debt, okay, when a debt is doubtful, now we need to make an allowance. When the allowance is made, we are saying that we should debit. So this is the entries, okay, when bad debts is what? Recovered. When the debt is recovered, we are saying that now we should debit our bank or cash account and credit our bad and doubtful debt accounts. Great. Now, when again we make an allowance for doubtful debt, when you make an allowance for doubtful debts, we are saying that we should debit bad and doubtful debts account. Okay, we debit bad and doubtful debt account, and we credit allowance for doubtful debt accounts. Allowance for doubtful debt accounts. Okay, good. So this is where an allowance is made. Don't forget, the allowance for doubtful debt is the same as provision for doubtful debt or provision for bad and doubtful debts. Good. Now, allowance is a credit balance which is then set against the carrying amount of receivables in the statement of financial position. So let's look at how an allowance for doubtful debt affects the debtors figure in the balance sheet. So now we are saying that in your balance sheet or statement of financial position, if a particular debt has proven uncollected, that's specific bad debt, that amount needs to be deducted from the debtors figure before charging the allowance. The allowance. Good. So you can see that we say trade receivables, net of bad debt written off. So if a particular debt has been written off, we need to take it out of the debtor because it will reduce the debtor's figure. Then having done that, we then come and charge the allowance. That is the provision that we are making for those debtors or those receivables that we think we may not receive. Okay, we take that one from it, then we get our trade receivables on the face of the financial position. Good. Now again, since the business will be making the allowances year on, that may result in an increase or a decrease in the allowance. How do we account for it? Okay, so that is accounting for changes in the allowance account. As we make an allowance this year, in the following year, we need to also make an allowance. What if the one you make this year is more than the previous year, or that is less than the previous year? How do we account for it? So let's look at accounting for changes in allowance accounts. Now, the double entry shown above is a little simplistic. In practice, a business will recognize an allowance balance at each year end. When this is the case, it is the movement on the allowance that is recognized as an expense. Okay, good. So, for example, maybe you are in 2017, okay, and you made an allowance of say 30,000. In 2018, your allowance came to 40,000. Here we are saying that you are not going to recognize the whole 40,000 as an expense, but it is the difference between this and this. That's the amount of increase. So here, if 2018, the allowance has moved to 40,000, it means that there is a difference of 10,000. That's the increase in allowance for that one. This is the expense to be recognized, and this amount will be the amount to be deducted from the debtors figure in the in the statement of financial position, and this 10,000 goes to the P&L account. Now, if assuming in 2019 your allowance comes down to say 35,000, we are saying that there has been a decrease in allowance, meaning that now some of the debtors are beginning to pay, or some of the debtors are paying, and that is why our allowance has what reduced. So the reduction in allowance is a gain to the company. Okay, so here there has been a decrease of what 5,000. So this 5,000, okay, needs to be what credited to the bad and doubtful debt account. Okay, needs to be credited to bad and doubtful debt account and debited to the what to the allowance for doubtful debt account. Do you get the point? Good. When there's an increase, okay, you debit your bad and doubtful debt expense account and you credit your allowance for what doubtful debt. Okay, good. We'll look at the accounting entries and you appreciate. So note that allowance for doubtful debt, there could be an increase or there could be a decrease. An increase means that more of the debtors are not paying, and therefore the allowance goes up. Now, when the allowance decreases, there's an indication that some of the debts or receivables, okay, are now what paying, and therefore that accounts for the reduction. Why there's been a reduction in the allowance, okay, and when there's a reduction in the amount of allowance that we make on doubtful debts, it's a gain to the company. Okay, good. So let's take some examples. Let's take examples of this. Let's take the very first example. SNAM Limited has total balance for trade receivables of 25,000 at the year end. A review of the receivables balances highlights that one of its customers, Annette Limited, has gone bankrupt. SNAM Limited is owed 4,000 by Annette for design work done during the year. This debt is now considered irrecoverable. Required. What is the balance for trade receivables to be shown in the statement of financial position at the year end? B. What is the irrecoverable debt expense to be shown in the statement of profit or loss at the year end? Okay, good. So if you are looking at the amount to be shown in the statement of profit or loss and amount to be shown in the statement of financial position for receivables. Now, let's see. I'll use a simple extract. So we have SNAM. Limited. Okay, good. So we have the statement of financial position. Okay, now statement of financial position. So we'll have our trade receivables. Okay, at the year end is 25,000. Then we're told that there's a debt which has proven irrecoverable. So that's what bad debts. Okay, so we can say less bad debts, which is what 4,000, and so that will give us what 21,000. Okay, good. That will give us 21,000. Good. So that will be in the statement of financial position. In our statement of profit or loss, okay, we'll have our bad debt expense, okay, of what 4,000. So this will be the amount to be accounted for in the statement of financial position and the amount to be accounted for in the profit or loss account. Okay, great. Alternatively, now you can decide to open the trade receivables accounts, the trade receivables accounts. You can also open your bad and doubtful debt expense accounts. Okay, good. So we have our account here. account here. So you can say sales of 25,000. Okay. If at the end of the day there's a receivable that has been written off, that's an expense that comes to reduce the balance. So you can say bad debts of what 4,000. Okay, good. Then you come here and what debit or bad debt in the name of what trade what receivables 4,000. Okay, now at the end of the day, the trade receivables account needs to be closed. Is that not it? So balance carried down will be on 29,000. That's the adjusted balance. Okay, that's the adjusted balance. So you have 25. Okay, so we come here now. This is an expense. So at the end of the day, it needs to be transferred towards the P&L. Okay, so P&L becomes 4,000. Okay, because the debt has been written off, so it's an expense. Do you get a point? Good. Because we're asked to show the balance of trade receivables to be shown in the statement of financial position, that is why I opened or showed the statement of financial position with extracts. Then I've also indicated the statement of profit and loss with extracts. Okay, good. Now let's move on. Let's look at example 2. Example 2. Example 2. At 1st October 2014, a business had total outstanding debts of 8,600. During the year to 30th September 2015, the following transactions took place. Credit sales amounted to 44,000. Payment from various customers, that's accounts receivable, amounted to 49,000. Two debts for 180 and 420 were declared irrecoverable, and the customers are no longer purchasing goods from the company. These are to be written off. Required. Prepare the trade receivables ledger accounts and the irrecoverable debt expense account for the year. Okay, good. So here we have to open our trade we have to open our trade receivables account. To open our trade receivables accounts. We have to open our irrecoverable debt expense account. Okay. Our debits, our credits. It's important. So, what do we do? Now, we're told that at 1st October 2014, a business had a total outstanding debt of this. So that's the balance brought forward, because the business starts in October, ends in September. So October 2014 to September 2015 is 1 year. And we're told that at 1st October 2014, the business had total outstanding debt of 8,600. So that represents the receivables brought forward. Okay, that represents the receivables brought forward. So we say balance brought forward. That is 8,600. Now the question says that during the year, the following transaction took place. That is, credit sales amounted to 44,000. Now, when credit sales is made, we credit our sales account. So we need to debit our trade receivables account. The name of what? Credit what? Sales. Okay, and that is 44,000. All right, good. Again, we're told that payments from various customers, that accounts amounted to Now, during the year, some of the customers came to pay. Now, when customers come and pay, right, we will debit our cash book, right? So we need to credit the trade receivables account to reduce the balance. Okay, good. So on receipt of money from your customers, their debt will be reducing and your cash balance will increase. Okay, so on receipt of the cash, you debit your cash or bank account and you credit your what? Your trade receivables account. So yeah, I would say bank. I'll credit the trade receivables account to the bank, 49,000. That is to reduce their debts. Good. Again, we are told that two debts, 180 and 420, were declared irrecoverable. And the customers are no longer purchasing goods from the company. These are to be written off. So when a debt is considered irrecoverable, to be written off. Now, when the debt is written off, it also go against the debtor's figure, because on sale we debited trade receivable and credit sales. So on sale it increased the debtor's figure. So now if you are taking it off the books, if you are writing off the books, it means that the debtor's account needs to be what? Credited. So we come here and state what? Bad debts or irrecoverable debts. Okay, so now we have to add the two debts, which is 180 plus 420, giving us 600. Okay, so our recoverable debt is 600. Now, since the trade receivables account have been credited by bad debts, we need to come to the irrecoverable debt account, the bad debt account, and come and debit it, right? In the name of what? Trade receivables. The name of trade receivables. And the amount is what? 600. Okay, good. Now, at the end of the day, we need to balance off the account to know what is the balance sitting on our receivables account, on what is the amount to be transferred from P&L in respect of the debt that has been not written off. Because as soon as a debt is written off, it's an expense. So at the end of the day, you must close off the irrecoverable debts account to the profit or loss. And the trade receivables account will be shown on our statement of financial position as part of our current asset. Good. So let's see, at the end of the day, let's close off the books. So let's look at which side is bigger. We have 8,600 plus 44,000. That gives me 52. Here gives us 49,600. So the total should be 52,600. 52,600. Now 52,600 minus 49,600. That gives us 3,000. So it means that at the end of the year, our balance on the receivable account will be what? 3,000. So balance brought down is 3,000. However, the debt that was written off, okay, at the end of the year must be transferred to the profit and loss account as an expense. So in the P&L, when you go, you have to see bad debt written off. So here we write it off to what? Profit or loss. Also what? 600. And that closes this what? Account. Because once the debt is written off, it's an expense. So once the irrecoverable debt account has been what? Credited, it means that you have to go to the P&L and what? Debit. And when you debit something in the P&L account, you note what? An expense. Okay, good. So this is how we will go about this as well. Good. Good. Let's continue. Let's solve some other questions. I'll leave question 3 for you to solve. And you try your hands too on question 4. Okay. Now let's look at question 5. Let's look at question 5. Now, now, Islam has total receivables outstanding at 31st December 2002 of 28,000. She believes that about 1% of this balance will not be collected and wishes to make an appropriate allowance. Before now, she has not made any allowance for receivable at all. On 31st December, 2013, her trade account receivable amount to 40,000. Her experience during the year has convinced her that an allowance of 5% should be required. What accounting entries should SNAM make on 31st December 2012 and 31st December 2013? And what figure for trade receivable will appear in her statement of financial position as at those what dates? So I say that SNAM has total receivables, okay, outstanding at 31st December 2015 of what? 28,000. Now she believes that about 1% of these receivables will not be collected and wish to make an appropriate allowance. Before now, she has not made any allowance for receivables at all. On 31st December 2013, her trade accounts receivable amount to 40. Her experience during the year has convinced her that an allowance of 5% should be what? Should be made. And now we have to show the accounting entries. What accounting entries should SNAM make on 31st December 2012 and 31st December 2013? Okay. And what figures for trade receivable will appear in his statement of financial position as are those what dates? Good. Now you can see that as of 2012, so let's look at 2012. Trade receivable figure, trade receivables was what? 28,000 at the end of the year. Now, there's per experience says that what 1% of this will not be collected. Okay, if 1% will not be collected, that is what bad debts. So bad debts is equals to 28,000 times 1%. Okay, %. So what is 28,000 times 1%? That gives us 280. Okay, good. And we are told that on 31st December 2013, her trade accounts receivable amount for 40,000. Her experience during the year has convinced her that an allowance of 5% should be made. So it means that in 2012, she only estimated that about 1% of the debtors will not come and pay. Okay, so in 2012, he writes off what 1% of the debtors. Good. However, at the end of what 2013, now he's of the view that 5% is making an allowance of what 5%. So at 2013, trade receivable balance is equals to what 40,000 Ghana cedis, and there is an allowance. So it's making allowance for doubtful debt of 5%. So that will be 40,000 times 5%. So that gives us 40,000 times 5%. That gives us 2,000 Ghana cedis. Okay, good. So if you are looking at the accounting entries, SNAM will make on the and what figure for receivables will appear in the statement of financial position. So the accounting entries. So let's look at accounting entries. So these are a bit of workings. So in 2012, okay, SNAM is going to. So let's open the trade in 2012. This is the trade receivables account. Trade receivables. This is the trade receivables account. And this is the bad. Odd and doubtful expense account. Okay. So we have our uh, credit sales, say 28,000. So at the end of 20, we said there was a bad debt of what 280. Now this bad debt needs to be debited to this account, the name of our trade receivables. Okay, 280. 280. Good. At the end of the day, this must be sent to the profit or what? Or loss. 280. This closes this account. At the end of the year, we need to adjust for the irrecoverable debts. Okay, so 28,000, 28,000, 28,000, 28,000. So at the end of the day, we have 28,000, 28,000 minus 280. That is 27, 27, 720, 27, 720. 27, 780. Um, let's see. Okay, so this will be the entries for 2012. Okay, good. 2012. Now let's see in 2013. In 2013, our trade receivables count. Of our bad and doubtful bad and doubtful debt account. Okay, okay. So our trade receivables, let's assume credit sales is 40. Okay, and then our doubtful debts account. Now we have to make an allowance of what 5%. So when we found 5% of 40,000, what did we get? We got 2,000. So what it means that 2,000, we are going to debit this account rather than that for that account. Okay. No profit or loss. Of 2,000. Okay. And now we open our profit or loss account. Our profit and loss account. Debit our profit and loss in the name of bad and doubtful debts of 2,000. And the credits are it should be allowance for doubtful debt accounts. Sorry, it's an allowance that we need. So you have allowance for doubtful debt accounts. So that one will be credited in the name of what? Profit or loss 2,000. Okay, good. Good. Now at the end of the day, this is an allowance account, a provision account. So we need to close the account. Okay. So balance carried down at the end of the year will be 2,000. So we close it. So this 2013, this 2013, okay, this 2013, this 2013. Good. So at the end of the day, our balance brought forward in 2014 will be 2,000. Okay, good, good, good. So that you and what figure for trade result will appear in the statement of financial position as at those dates. Good. So if you are looking at our statement of financial position, the years ended 31st December 2012 and 2013. So I have 2012 here and 2013 here. So as of the end of 2012, let's go into our trade receivables account. Our trade receivables account as of 2012 we show a balance of 27,720. Okay, 27,720. So that's what we bring here. So trade receivables is 27,720 for 2012. Okay, good. Now for 2013, you can step it down. Our trade receivables. Okay, our trade receivables be 40,000 and we less allowance for doubtful debts, and that was 2,000. So debtors figure for 2013 will be what? 38,000. Okay, 38,000. Great. So this is how you can present it. Okay. But if you like to, you can do it year on year. Okay. You finish financial statement of financial position for 31st December 2012. So just show the 2012 one, then statement of financial position for 2013. Then show the trade receivable and less your allowance for doubtful debt. All right, good. So this is how the question 5 will be handled. Good, good. Now let's look at say question 7. Let's look at question 7. Let's look at question 7. On 1st January 2012, there was a balance of 500 in the provision for bad and doubtful debt account, and it has decided to maintain the provision at 5% of debtors at each year end. The debtors on 31st December each year were as follows. Show the necessary entries for the 3 years and the 31st December 2012, 31st December 2013 in the following account: allowance for doubtful debt account and profit or loss account. What is the difference between bad debts and provision for bad debts? Great. So now let's see question 7. Question 7. We have to show the one allowance. So let me look at the allowance for doubtful debt account somewhere here. Allowance for doubtful. And the next thing is what? Provide profit and loss account. Okay. Now, so 2012, 2012. 2012, 2012. All right. So for allowance for doubtful debt, we know that they had a balance at the beginning of the year. Now, don't forget that we have already indicated that allowance is a provision. Okay, so it's more or less like a liability, okay, to the business, because we've so who's expected to receive money. Now they are not paying. I saying that we are making allowance. We are writing that figure down gradually. So as we write them down, it becomes a provision, okay, more of a liability to the business. Okay, good. So if there's a balance brought forward, that is as of 1st of January 2012, our balance brought forward was what? 500 cedis. Okay, good. And they say that in the provision for bad debt accounts, that is the same as allowance for bad debt or allowance for doubtful debt. Okay, and it was decided to maintain the provision at 5% of debtors at each year end. So now, at the end of 2012, our receivables figure was 12,000. So we find 5% of 12,000. Now, when we find 5% of 12,000, sorry, that is 600 Ghana cedis. That is 600 Ghana cedis. So what this is telling us is that at the end of 2012, which is our balance carried down on this account, okay, because it is an allowance that we have made 5% of the debtors at the end. That is 600. So at the end of this year, okay, it means that our closing balance on the allowance for that debt should be 600. Okay, Good. Now, if this should be 600 at the end of the year, then we can see that at the end of the year, there has been an increase in the allowance. At the beginning of the year, we are making an allowance of 500. At the end, we are saying that we should make an allowance of 600. Now, what it means is that the allowance at the beginning is smaller than the allowance at the end. Meaning, at the end, we are making more allowance, which may be an indication that some more of the debtors are not what paying, and therefore that's why the debt has not gone up. Okay, good. So this difference, how do we account for it? Now, the difference must be sent to what? P&L. Okay, profit or what? Or loss. So we come here, we see what? Profit. Sorry. This is the balance at the end of the year. That's 2012. At the end of the year, our allowance has gone up to 600. So it means that the difference, okay, that's 31st December, our P&L should be what? 100. Okay, so we come to the P&L account. So I can see that an allowance account has been credited so as to equalize the debit side of the allowance account. So here we have 600, we have 600. So we come to 13. Come to 13. 2013, 1st of January, we have our balance brought forward to be what? 600. Okay, good. Now in 2012, the profit or loss. Now we have credited profit or loss. Okay, in the allowance for that for that account. Or sorry, we have credited the allowance for that for that account in the name of P&L. So you have come to P&L account and come and debit it. That's at the end of the year in the name of what? But allowance at the end of the year, we have 31st December. 31st of December, we have allowance for bad what? Debt. And that is what? 100. Okay, that's an expense. So that ends there. Now in 2013, okay, now at the end of the year, our receivable balance is 8,000, which means that debtors are paying. Now, if there's 8,000, we have to make the allowance, maintain the allowance at 5% each year. What is 5% of 8,000 times 5%? That gives us 400. So it means that there has been a decrease in the what? Allowance that we are making. Okay, so we come here at the end of the year, which is 31st of December 2013. Our balance carried down will be what? 400. Okay, good. 400. Now, if it is 400, what it means that there has been a decrease in the what? Allowance. Okay, so we are making allowance of 600. Now we are making 400. What it means is that there has been a decrease in what? Allowance for what? Doubtful debt. And that is a gain, because once the debtors was 12,000 in 2012, and now it has come down to 8,000, it means that the debtors are paying. Okay, and once debtors are paying, that has improved our allowance position, meaning that more and more of the customers are paying their debt. Okay, that is why we are getting a reduction in the allowance. Good. So we come here. That is 31st of December. Our balance carried down is 400. What it then means is that as of 31st December, our profit or loss is what? 200. Okay, making this 600, making this 600. So the difference should now be credited towards the P&L account. So it's a gain. Okay, so we come here as of 31st December, we say allowance for bad debt, and that amounts to 200. Okay, good. Then we come to 2013. We come to 2014. Our balance brought forward as of 1st of January. Okay, as of 1st of January, balance brought forward is 400. It's 400. Balance brought forward. Balance brought forward is 400. Okay, good. Then as of 31st December, as of 31st of December 2014, what will be our balance carried down? What will be the allowance that we'll be making? The 2014, the debtors figure is still 8,000. 8,000 times 5% still gives us 400. So at the end of the period, we have 400. Now, you can see that the balance brought forward and the closing balance are all the same, meaning there has not been any increase. So it means that it's the same. So here we will not charge anything as an either an expense or as a gain because we have 400 here, 400 here. Okay, good. And it means that no expense or no gain was made in 2014. We are making the exact amount of allowance that we made in the prior year in the current year. So what it means is that the debtors are now what paying, okay, or there's no doubt as to whether any customer will not pay or not, and that's why it's the same. Okay, so you can see that in the first instance there was an opening balance of 500. Then at the end of the year, the allowance moved to 600. Here, what was actually recognized as an expense was the difference. That's the increase. In the subsequent period, okay, we saw that the allowance have reduced from 600 to 400, meaning that there was a reduction in the amount of allowance that we make. And when there's a reduction in the amount of allowance, the reduction represents a gain to the company because the debtors are paying. So now we are having to make a lesser allowance for debtors. It's a gain to the company. So that's why the profit and loss account has been credited. Okay. In the third year, there were no movement in the allowance for that full debt, and that is a good sign that the debtors are not paying or making good their debt. Do you get the point? Good. So this is how you account for it. Already, the difference between bad debt and doubtful debt was looked at the beginning of our lecture. Said that bad debt is a debt that has proven uncollectible. In the case of a provision for bad debt, they are saying that we are acting prudently in the sense that if debtors are not paying, okay, now we need to write off, okay, a portion of those receivables because if you don't do that, then we are still keeping the receivables in our books at its value at which we sold goods to them, and that does not make sense because the amount we expect from those debtors, okay, is lesser than the book value. So there's a need for us to write off the what sum of the balance. Good, good. So let's take our last example on bad and doubtful debts. Bad and doubtful debts, and we can take it off from there. So here we have to prepare the what? Bad debt accounts, doubtful debt accounts, irrecoverable, income statement extract and state of financial position extract. And that is a ICMA 2014 exam question. So let's look at how this will be prepared. Okay. So here we have Jewa Enterprise. Let's repair one. Bad debts account. Next for us is to open allowance for doubtful debts account. Then to show the income statement extracts, different extracts and statements of financial position extracts. Okay. Okay, so let's look at this. So accounts receivable has been presented to you to December 31st, 2009, 2010, and 2011. After discussion with Ejewa, the owner, she agreed the following accounts should be written off as bad debts. So in 2009, okay, at the end of the year, said that bad debts to be written off was what? 45,000, 15,000. Great. So when there's a bad debt, it means that the trade receivables account to be credited. So the bad debt account as of 2009 will be debited. Okay. At the end of 31st of December, there will be trade receivables of 45,000. Okay, good. Now this balance, okay, we would have to be transferred to the P&L account. So we have, as of 31st of December, we have P&L of 45,000. Okay, good. Now we're told that allowance for doubtful debt is at the rate of 5% on the net account receivables. Okay, the balance on the allowance for doubtful debt at the beginning of 2009 was 35,000. So we come to the allowance account. As of 2009. Okay, as of 2009. That is 2009. As of 2009. Okay, 1st of January, our balance brought forward was 35,000. Okay, good. And now we are told that the allowance for doubtful debt is at a rate of 5% on the net account receivable. Why net? Because at the end of each of the years, there was a debt written off. So to know the good debtors, let me put it that way, to know the good debtors, you have to pick the debtors figure at the end of each year and deduct the amount that was specifically written off in respect of each year before we charge the allowance. So if you take 2009, the debtors figure was 750,000. Out of this, 45,000 was declared bad and to be written off. So it means that the good debtors will be 750,000 minus 45,000. That gives us 705. So it's on this 705 they are going to charge the allowance. That's why I say that's 5% of the net accounts receivable. Good. So we have 705,000 times 5%. Now that gives me 35,250. So that is the closing balance. So you come here. As of 31st of December, our balance carried down is 35 250. Okay, 35 250. 35 250. Now the difference, which is at 31st December, goes to what? The P and L of what? 250. Okay, good. So in 2010, we have 1st of Jan, balance brought forward will be 35 250. Okay, good. Now let's look at 2010. Let's look at 2010. Now 2010, again, we're told that debtors of 15,000 should be written off. So we come here as of 31st of December, trade receivables of 15,000. Now 15,000 is an expense, and so at the end of the period, we will send it to P&L. 15,000. That closes this account. Now at the end of 2010, 31st December, we have to charge allowance, and in 2010, the total debtors is 960,000 minus 15,000 will give us our net receivables. That is 945 times 5%. That gives us 47 250. That gives us 47 250. So there has been an increase in the allowance from 35 250 to 47 250. So minus 35 250. That gives me 12,000. So that's an increase. So that goes to P&L. So we have P&L 12,000. Okay, good. So when that adds up, we get 47 250. 47 250. Good. So let's look at 2011. 2011. Okay, 2011, 10,000 was written off as bad. So as of 31st of December, our trade receivables will reduce by 10,000. At the end of the period, we need to send that 10,000 to P&L, our profit and loss account. Okay. Now, in 2011, our allowance, our balance brought forward as 1st of January. Our balance brought forward is 47 250. Now, at the end, 31st of December, 2000 balance carried down. Now, our receivables 870. 870 minus 10,000, that gives us 860. 860 times 5%, that gives us 43. So 43,000. That means that there has been what? A reduction in the receivables. It was from 47 250 to 43. There's been a reduction of 4,000. So we come here at 31st December P&L. That is 4,250. That's a reduction. That's why we are debiting the P&L. So when we go to P&L, we need to credit P&L. Good. Now, we're to show again the income statement extracts. Okay, we're to show the income statement extracts. So quickly, let's look at the income statement extracts. Let's look at the income statement extracts. Let's look at the income statement extracts. Good. So let me clean this side. So to the income statement extracts, we have 20, 10, 20, 2009, 2010, 2011. So we have bad debts. Our bad debt for each period is 45, 15, and 10. Okay, these are all expenses. Good. And you can talk about allowance, allowance for uh, what allowance for doubtful debts. The first year it was a loss of 250, a loss of 250, 12,000, 12,000, and a gain of 4,250. So that'll be a credit because it's a gain. There's a decrease. Okay, good. So that's a gain. That's why it's in credit. Good. And we are going to show what the statement of financial position extract. So we come here of the statement, of financial position extract. That one too, we have 20,009, 2000 2010, 11. So we have the trade receivables, which were 750, receivables 750, 60, and 870. Okay, so we less bad debts, which were 40, which were 25,000, 15,000, 10,000. Okay, when these are deducted, we get to know our good debtors. So you have 705, 960 minus 15, that gives me 945. 870 minus 10, that gives me 860. And now I'm going to deduct my allowance for doubtful debt. That's the closing balances. Less allowance for doubtful debts. Allowance for doubtful debts. At the end of the year, we have 35,250. Let's go into the allowance for doubtful debt account. At the end of 2009, we have 35,250, 47,250 for 2010, 47,250, and last year we have 43,000, 43,000, and the 43,000. Okay. So let me clean the last here because it denotes that we are deducting the brackets. Okay, 35. Okay. So 705,000 minus 35,250. That gives me 669,750. Of 945,000 minus 47,250. That gives me 897,750. Of 860,000 minus 43,000. That gives me 817,000. Good. So these are the disclosures or what the work requires of us. So if you looked at the bad debt accounts, we've looked at the allowance for doubtful debt accounts, and we've shown the income statement extracts, which basically takes care of the bad debt and the allowance for doubtful debts. And in the statement of financial position, we need to also deduct the bad debt return because they were written off at the end of the year. So we need to show the deduction and then also show the allowance for doubtful debt as well. Good. So this is how the account will look like. Good. So this is how we account for bad debts, doubtful debts, and allowance for doubtful debts. Okay, good. This is how we account for them. Okay, good. So now to accruals and prepayments. Let's look at accruals and prepayments. Okay, good. Now, the accruals concepts, the accruals and prepayments is premised on the accrual concept. Okay, good. Now you're saying that financial statements are prepared using the accrual basis of what? Accounting, rather than on cash basis. What this means is that sales are recognized in the same period as the related cost of making the sale. Okay, great. Now income is recognized in the statement of profit or loss in the same period as the transaction that give rise to it, not necessarily when cash is paid. And expenses are recognized in the statement of profit or loss as they arise, not as they are paid. Okay, good. For example, the cost of rental charges on office accommodation should be spread over the period of time to which the rental payment relates, regardless of when the actual payment of rent occurs. Okay, good. So the accrual basis of accounts, we are saying that sales are recognized in the same period as the related cost of making the sale. And income is recognized in the statement of profit or loss in the same period as the transaction that gave rise to it, not necessarily when cash is paid. And expenses are recognized in the statement of profit or loss for the profit or loss as they arise, not as they are paid. Good. So we have used an example of rental charges on office accommodation should be spread over the period of time to which the rent payment will relate, regardless of when the actual payment of rent occurs. Okay, good. Now, good. So let's look at the accruals. Good. Now, for example, the basic thing that we are looking at here is that the financial statements are prepared for a year. So what you are saying is that, for example, if a business has rented its business premises, okay, and say they pay rent of say 12,000 a year, okay. However, during the year, maybe the company might have been able to pay, just say, 6 months out of the 12 months. Now, at the end of the year, now we want the financial statement to project the income and expenses for the year. So the expenses that the business has not paid, they must what? Accrue for it. They must add it to the one that they have been able to pay. Again, there may be instances where maybe the rents are billed every quarter. So maybe at the end of December, the last quarter bill might not have come. Now, because we are projecting income for 1 year, we must also compare the income with the expenses for the same year. Okay, good. So even if the invoice has not been received, we can estimate, okay, what the 3 months rent will be, and then add it to what we have actually paid. Okay, good, because we are looking at matching revenue for 1 year against expenses for 1 year. So any expense that we should have paid, that due to one reason or the other we have not paid, either maybe the business is cash strapped or does not have the enough resources to pay, or the supplier has not given us an invoice. We are saying that the fact that the supplier has not given us invoice doesn't mean that we shouldn't account for it. We need to accrue. We need to assume, okay, that had we paid, how much would that be? Because we are matching revenue for 1 year against expense for 1 year. So any payments that we should have made that we didn't make, we must accrue for it. Good. So we are saying that a business might incur an expense before the year end, but not receive an invoice till after the year end. If this is the case, the business might estimate the amount, okay, of the expense and recognize it as an expense and a liability. Okay, if this is the case, the business must estimate the amount of the expense and recognize it as an expense as well as a liability. An expense as well as a liability because the amount has not been paid yet. Okay, good. A liability is known as an accrual. The business is said to be making an accrual for the expense or accruing for the what? For the expense. Okay, good. Good. Now, when it comes to prepayments, just as I use the rent example, now a business too can rent a business premise and maybe pay 2 years rent in advance. Now, we are saying that if the business is preparing to account for its first year, the rent that they have paid for the second year does not relate to the current year, okay? And therefore, that amount is seen as an asset to the company. Why an asset? Because the landlord is now owing the business for the year's rent which they have not enjoyed, okay? And therefore, we are preparing the account. Now, we must factor only 1 year's rent because we should have paid the rent for just that year, but we have paid for 2 years. And because we're preparing the account for just a year, we need to match the income of 1 year against the expense of 1 year. So any expenses that we have overpaid, okay, the amount of overpayment must be taken out of the total payment so that the portion that relates to the current year alone will be factored. Okay, good. So I said business might pay or at least be invoiced for some expenses in advance. When the invoice is received, the business will recognize the full liability as a debit in an expense account. It will be wrong to then clear all of this to the statement of profit or loss in the current period. Some of it relates to the next period. This part must be recognized as an asset. That is, it represents a right to receive some kind of service in the next period called a prepayment. Okay, so if a business, okay, makes payment in advance or pays for an expense, okay, in advance, they are saying that the portion that they have paid in advance, it represents the company's right to receive some kind of service in the next period, and that is termed as a prepayment. Okay, good. Now we are saying that to account for this prepayment, any amount overpaid has been taken from the total payment, and the portion that relates to just that year should be accounted for. Okay, good. So, great. There are so many ways of accounting for it. We're saying that there are two approaches to how we can account for amount of. There are two ways by which we can account for accruals and prepayment. Either we use two accounts or we use just a single account. Okay, good. So we've demonstrated the the theoretical aspects. Now let's look at how we will handle questions on this. Good. So we have the company makes up accounts each year to 31st May. The rent on the company's premises is payable quarterly in advance on 1st January, 1st April, 1st July, and 1st October. Service charges are set in respect of a year running from April to 31st March. It is paid each year in 2 installments in advance on 1st April and 1st October. The annual rent for the calendar years 2017 for 2017 was 6,600 and 7,000 respectively. But on January 2008, it was increased to 7,800 per annum. Service charges for the last 3 years have been as follows. So 2016, 2017, 2017, 2020, 2019. And the requirement is that what is the charge for rent and service charges in the statement of comprehensive income for the year ended 2008, and what accruals or prepayments will be carried forward at the year end. Good. Now I'll leave this question for you to try your hands on it after I've solved the others. Good. So let me look at question 2. Question 2 for you. Good. Now, the following information relates to the books of Ejaco Enterprise for the year ended 2006. Paid electricity bills 305, paid telephone bills 404. The following bills were outstanding at the following dates. So we have bills outstanding at 1st January 2006, and we have bills outstanding at 1st January 2006. We have electricity and telephone. The requirement is for us to prepare the electricity expense account and the telephone expense account and state how much will be charged as an expense in the profit or loss account. Okay. So let's look at this. Question 2. Let's look at how we go about it. All right. So we have to open the so we have Ejaco Enterprise. We have to open the electricity expense account. We have to open telephone. Okay. So let's see. We got 2006. 2006. 2006. Good. So now you can see that we are given outstanding bills at the end of the year and at the beginning of the year. Now we know that if an expense is outstanding, it's a liability. When an expense is outstanding, it's a liability, and liabilities are what? Credit what? Balance. If liabilities have credit balance, then it means that the open balances on the both electricity and telephone bills account should be credited to their respective what? Accounts. So we come here, electricity, our balance brought forward. Okay, is what? 230. So that comes here. Now the balance on telephone, balance brought forward. Okay. Let me use the date as well. So that's 1st of January. Our balance brought forward on telephone is 460. Okay. Then the balance on on 1st of January, our balance was forward on electricity was 230. Now, during the year, we are told that the following relates to the books of the for the year ended. Paid electricity bills 305. So when electricity is paid, okay, we debit the electricity account and we credit the bank account because our bank account or cash book or cash balance will reduce when we make payments. Is that not it? So we credit the cash book to have to debit the respective expense. Good. So we come here, we said paid during the year. So we say bank, electricity is 305. So we do the same for telephone. Okay, bank 440. Okay, good. Then we're given the outstanding balances at the end of the year. Now it's a liability. So for a liability, it is the balance brought down on an account that shows the balance that the account is having. You get a point. Good. So if you take the electricity, now there's an accrual of what? 320. They're saying that the accrual simply means it's an expense that we should have paid that we didn't pay. So we must add it to what we have actually paid. So we come here, and because it's also a liability, we must make sure that the balance brought down comes to the credit side, showing a liability or a credit balance. Okay, good, because liabilities have a credit balance. So you come here, you say 31st of December, balance carried down. Okay, or you can say accruals. Okay, and for that of electricity was 320. So we are adding to what was paid. Okay, good. So this gives us 625. So the difference represents the expense for the period. So we say profit when we use P&L. So we say P&L 6305 plus 320, 625 minus 230. That gives me 395. Okay, 395. So as of 1st of January 2007, our balance brought down is 320, indicating a liability because it's at the credit side. This is a debit, this is a credit. So this denotes a liability. That's a credit balance. Okay, good. Now you come here, you do same. The 1st of December, our balance carried down in our electricity account, which is the amount that was owed at the end of the year, was what? 640. Was 640. So you add it. Okay. So 440 plus 640, that gives us 10 and 80. 10 and 80. So the difference as of 31st of December, that's P&L. That's 1080 minus 460. That is 620. Okay. So as of 2007, 1st of January, our balance brought down is 640, indicating a liability. Okay. So this is how the accruals works. So the B states how much will be charged expense in the profit and loss account. So that's the P&L. So for electricity, the B part, electricity expense of 395 cedis would be charged towards the profit or loss account. Okay, and it stays same for an amount of 620 will also be charged to profit and loss in respect of what? Telephone. Okay, good. Okay, all right. So this is how we can account for this. Okay, good. So you need to understand the double entry. Great. Now let's look at Let's look at question 6. Let's look at question 6. Now you're seeing that the following balances were extracted from the ledger account of Apollonia as at 31st March 2014. We have insurance is debit, we have commission credits, we have telephones debit, we have carried 308. Now the following adjustments are required in respect of these items. I, insurance is prepaid by 156. Okay, the business is owed 100 Ghana Cedi commission. 3, there is a telephone bill outstanding of 304. IV, carriage cost of 60 are owing. What are we to do? Required. Show the ledger account for each item above after adjustment has been made. And after the adjustment has been made, and shows the transfer to the statement of profit or loss. Okay, all right. So question 6. So we have Apollonia. We have insurance accounts. Of insurance, of commission account, we have what? Telephone, carriage, cost account. All right. So now we have insurance in the trial balance, that is 564, meaning that during the year, that's the amount they paid for insurance. We know that insurance is an expense. When it is paid, cash to be or bank to be credited. So we need to debit that account. So here we say bank. Okay, 564. Now let's look at the information on insurance. So that insurance is prepaid by 156. The foreign adjustment are required in respect of the items, and we are looking at this adjustment at the end of the year. So if at the end of the year there's a prepaid insurance, it means that we have paid more than is needed for the year. So what do? We need to deduct the amount that we overpaid so that we know what we should have paid for the year. Okay, and an amount prepaid at the end of the year in respect of an expense is an asset to the company because the company is here to enjoy the benefit. Now, an asset has a debit balance. So at the end of the year, what do? We need to credit this account. And how do we credit it? We credit it by introducing a balance carried down. Okay, of what? 1546. That's the amount of prepayment. Okay, good. So this gives a 564. 564. Now the difference is the amount that goes to P&L. Okay, that's the amount of expense that we should have actually paid. Okay, so 564 minus 156. That gives us what? 408. So this carried down comes to the debit, indicating an asset brought down. What? 156. That denotes what? An asset. Okay. Now, so when an amount is prepaid, the amount of prepayment must be deducted from the total amount paid, so that the difference. So here you can see that we paid 564, but what we should have paid for the year is 408. So the amount of 156 is a prepaid expense, which is an asset because we have paid more than we should have. Okay, good. Now the next thing is commission. But here you can see that the commission is at the credit side of the trial balance. Now what this means is that the commission is an income. it's an income. So here, since at the credit side of the trial balance, means that on receipt of the commission, okay, now our bank was what? Debited. Okay, so we need to credit the commission account, the name of bank, 300. Okay, good. Now let's look at the additional information. I said the business is owed 100 Ghana cedi what? Commission. Now, since it's an income and the business is owed commission, maybe we did some work. Apollonia did some work for somebody who has to pay, or who are required to pay Apollonia a commission. And for one reason or the other, they have not been able to pay all. Okay, so commission receivable. Commission receivable. This is a commission receivable. Okay, and commission receivable is what? It's a gain to the company. Is that not it? It's a gain to the company. So how do we treat it? We are supposed to receive the income and we have not received it. Okay, so what do we do? It's an income owed. We need to add it. Okay, we need to add it to the amount that we have already received. Okay, so we come here. We say 31st, our balance carried down, which is 100 Ghana cedi. Okay, so we come here. So note that income receivable is an asset to the company. Okay, so sorry, income owed the company. Okay, so it's a receivable. So we come here, we have 400, so P&L. It means that the actual amount of income that should be shown in our account should be what? 400, because we should have received 400 and we have only received what? 300. So commission owing, okay, it is being owed to the company. So we come here, our balance brought down is what? 100. Okay, up we are following. Good. Now the telephone is an expense, so we debit our telephone expense, the name of bank 1172. We are told that there's telephone bills outstanding, meaning we should have paid and we didn't pay. So we need to add it to the amount of expense. So that is balance carried down. The amount is what? 304. So we add it here. So 1172 plus 304. That gives us 1476. 1476 for P&L. So meaning that during the period we should have paid an expense of telephone expense of 1,476. Just that we are only able to pay 1,172. But because we want to know the total expense that we should have paid for the year, that's why I've added the amount of telephone amount of owing. So you can see that the balance brought down comes to the credit, denoting a liability. Okay, good. The last one is the carriage, which has also debited in the trial balance. So we come here, that's our bank, that's 308, and we're told that carriage cost of 60 are owing, meaning we are owing people, maybe people that we contracted to maybe bring our goods to our business premises or any other form of goods. Okay, good. So you come here, you have to add the amount that is still owing. So here is 60 Ghana cedis. That will be added. So balance brought down 60. So this gives us 60 plus 308. That gives us 368. 368. So the P&L is 368. Indicating that during the production, pay the total carriage cost of 360. Just that we paid only 308. So the amount that we are still owing should be added. Okay, and always take notes the brought down of an account to note the balance that the account is having. Okay, good. So for income, for example, we have the balance brought down at the credits. Sorry, at the debits. There's an income owed. Okay, commission is an income to the company. So if the company is owed commission, it represents commission receivable. And commission receivable is an asset to the company. Okay, good. All right. So this basically brings us to this session. That's end of year adjustments. So if we looked at how to account for bad debts, doubtful debts, and how to show its effect on the statement of financial position, statement of profit and loss. And again, if we looked at accruals and prepayments, okay, just to demonstrate how the adjustment should be done. If an amount is prepaid, if an expense is prepaid, what it means that we have paid more than, and because we want to show income for 1 year against expense for 1 year, the amount that has been paid must be deducted from the total that was paid during the period. Again, if there were expenses that we should have paid during the period we didn't pay, or we didn't receive invoice on time, we are saying that we should estimate the amount that we should have paid that we didn't pay, or for which invoice was not received. We should add it to what we have paid to know if we had paid, what would have been the total amount, and therefore compare that total expense against the total revenue for that same year. Okay, good. So basically, this is what this session is all about. I implore you to continually go through the Institute manual, the question bank. You see practical exam type questions on this kind of end of year adjustment. Practice a lot of them, and you master the basic adjustments. Okay, it's very important that these basic adjustments are at your fingertips. It helps a lot so that in exam you don't need to fumble. Okay, so do take the lecture notes seriously. Okay, solve as many questions as you can because there are a number of illustrative examples in there. If you are challenged in any way, do feel free to contact me via WhatsApp, phone call, and I'll be more than happy to assist you. Do enjoy the rest of the day to meet again. Bye bye.